Well, hello again. Merle Dimbath here, Conch Economist, reporting on the big events of the past week. And there was mainly one big event, and that was the cut by the Federal Reserve of the discount rate by a quarter of a point, or the federal funds rate. Remember, these are very short-term rates. Federal funds, this is the interest rate that banks pay each other when they borrow reserves from each other. The discount rate, or sometimes referred to as the repo rate, is the interest rate that the Fed charges when banks borrow from it. It was widely expected, but what did it really matter? What did it accomplish? We'll get into some of the details in just a moment, but first we'll start with a picture story. Pictures tell a lot of words, and the picture today I have is a graph that shows the yield curve last week and the yield curve the preceding week. In other words, we've got a 7-day difference in the yield curve before and after the Fed decision. Let's see what really happened. We'll start today by looking at a pair of yield curves. Now let me explain what a yield curve is. A yield curve is where we plot on a graph an interest rate that corresponds to a specific period of time. For example, the black line here is data ending at the close of Friday, December the 5th. The red line is a week later on December the 12th. So let's look at the black line, and we can see that the 1-month yield as of the close of trading on Friday the 5th was just a little over 4%, and so there's our dot. And then on the for the 6th month at that same period of time, the yield was 3.74%, and it reaches a low point there at 3 years, 3.49%, and then shoots up and reaches a high point for that Friday the 5th of just a little over 4.67%. All right, now, what has happened as a result of the Fed's lowering of the discount rate by half a point? Well, this fishhook pattern, that's what I'm calling it, kind of a fishhook pattern, has basically just been twisted. Yes, the short end did fall. We did see a decline in the 1-month yield. We did see a decline in the 6-month yield, the 12-month yield. But notice, by the time we get to 3 years, rates are up. And from that point on, the rates now are higher than they were a week ago. So where is the lower rates? This picture tells a lot. As part of the Fed decision last Wednesday, Chairman Powell announced that the Fed would begin purchasing great quantities of short-term government bills. Why? For the purpose of trying to lower the short-term interest rates. As we can see, short-term interest rates are higher and then go lower, but at the very short end here, at the 1-month and 3-month, rates are higher than the Fed would like. So the Fed is going to be buying short-term securities, short-term treasury bills. As they buy more, they hope to bid up the price of the bonds, or the bills, I should say. And by bidding up the price, as we know from our previous discussion, as the prices go up, the rates go down. We're now looking at the chart, which is an expansion of the chart that I used last week, where we were looking at interest-bearing assets based upon the yield curve. And at the top here, we've got various periods of time for the Treasury yields. For example, a week ago, Treasury yield was 4.05. The Fed made their decision, and yes, the 1-month did drop to 3.67. And the 6-month went from 3.74 down to 3.59. The 1 year fell from 3.61 to 3.53. But notice at year number 3, we no longer were experiencing declines. From that point on, yields went up. Now, please understand that bonds, like stocks, are traded daily, and yields can change by the day, indeed by the hour. So if you check to see what is the 6-month yield today, it may be slightly different than, say, 3.59%. But the general pattern is pretty clear here. Now, it's also interesting to note what has happened to the ETFs. Now, I've used the term here interest rates to describe what's happening here to the U.S. Treasury securities. I'm using yield to show what you would earn on various types of ETFs. These are exchange traded funds that uh, tend to pattern the period of time or duration of corresponding treasuries. And the short term bill, BIL, which trades as an ETF, you can go onto your stock account and enter BIL, and this ETF will come up. The ETF on the Friday close of 12.5 was $91.48, and the yield was 4.19. Now, as a result of the Fed's decision, we did see the yield drop to 4.14, but remember, there's an inverse relationship, and we've talked about this in the past. There's an inverse relationship between yield and price. But notice, okay, the yield went down, but what would we expect? We would expect the price of the ETF to go up, and it did. It went from $91.48 to $91.60. So if we go on out there to say the 6-month X bill, which that's an ETF that tracks the 6-month Treasury. Okay, in the previous week, the yield was 4.11, and yes, the yield went down to 4.05. So with a falling rate of interest or return, would we expect higher price? And yes, we got it, from $50.06 to $50.15. And in a similar pattern, you can go all the way out to, say, the 30-year bond. Okay, the 30-year bond went from 0.467 to 4.85, and not surprising, the yield on the corresponding ETF, which tracks the long-term bond, went from 4.37 to 4.43. Now, with higher interest rates, would we expect a lower price? And we got it, from 55.60 to 56.50 to 55.74. So we can see in the schedule here, and I'm not going to read them all. You can look at them or look them up. But when we saw an increase in yield, for example, in the 10-year yield on the TLH from 410 to 416, we got a lower price from 102.70 to 101.41. But as a result of what's happened, not much change in the 30-year mortgage. When I last checked, the 30-year mortgage was down ever so slightly from 6.3 to 6.28, but hardly much to encourage home buying or to make it any easier. A couple of other interesting things here. With lower interest rates, we would expect a lower dollar, and that has been happening, and we can see that reflected in the price of a euro. In the previous week, you could buy a euro for $1.16. It's now going to take $1.17. So as the dollar falls, the price of euros and other foreign currencies go up. Well, as I have said previously, the Federal Reserve's continuing policy of an interest rate structure that produced interest rates that were too low to fight inflation, but too high to help housing and other sectors of the economy, has produced a situation of where the economy is moving forward, but a lot of the people are left standing still. It's a sad tale. Maybe the coming year will produce better results. We'll see. The coming week, for sure, is going to produce a lot of economic data which we have missed because of the government shutdown. But there's a lot of reports coming, and so in our report of next week, we'll review this data and see what it tells us in terms of the outlook for 2026. So this is Merle Dimbath, your conch economist, thanking you for watching.